Good morning. Good morning. How are you guys this morning? It's great to be here with you. Today, we are going to review our trades, the ones that we did yesterday. I'm going to show you what happened. And this is a little weird what I'm seeing on the screen right now. This is leftover from yesterday. And these are the insurance policies. Now, one suddenly dropped to 250. It was all, I don't know what happened. That was really weird. That thing suddenly shot to a negative 250. It was like $75, and now it's like bam, like that. It went to 250. I don't know if that's because of the sudden increase in implied volatility or what, but I don't want to take it off at a negative 237 when it was just $75 20 minutes ago or 10 minutes ago. All right, guys, I am my name's Lan Turner. I am the instructor today. Former instructor of the Chicago Mercantile Exchange, the Board of Education Centers, and I am an instructor at Utah Tech University. So I'm glad to have you guys here with me today. Those of you who are from the university coming to our class and learning a little bit about the things that we've taught in class. And then, of course, for those of you who are from YouTube, you're always welcome. Everybody's welcome. And what we do in these classes is we learn, we practice, we study, we try to make ourselves better traders so that we can apply the technology or the learning that we do in these classes to our real money trading. I want to review with you the trades that we did yesterday. We did a bunch of testing and trying new stuff, so we need to review what that did. And then I also want to go over and review our options in the stock market because we have a class portfolio in the options, stock options, and we need to go review that as well. So that's what we've got on track for today. If you want to go look at our stock options portfolio with us, we'll go look at that in just a few minutes. But first, I want to review what we did yesterday. We'll kind of watch the opening bell here in the futures market. Up in the upper left-hand corner, you can see that we have the S&P 500 in the bottom. In the bottom left-hand corner is the Russell. In the top right corner is the Dow. In the bottom right corner, there, that's the NASDAQ. Now, we do have some, those of you who are new with us, we do have some unique, a little bit unique candlestick charts. What am I trying to say here? Some unique charts on the screen. These are Heiken-Ashi range bar charts. All right, so that's what we're looking at. Now, that up here in the upper left-hand corner on the S&P 500, that's a 2-minute chart. So that was just kind of a typical, normal, everyday 2-minute chart. Let's put on some moving averages here. Just there we go. So we got a simple moving average set up here with 50, 100, and 200. That's what that is. And then over here, there's the opening bell, and watch the market take off and run. Now, it rallied, the Russell down here rallied a little bit on the pre-market session. Now, over here in the futures market, we can trade 23 hours a day. We close the market just for an hour in the afternoon. But the stock market actually has a pre-market session. So in the pre-market session, they ran it up a little bit. And we don't have any restrictions like they have over in the stock market. We can go long, short. We don't have pattern day trading rules. We don't have any of that problem that those guys have to deal with over there, over here in the futures market. So we can trade these things like to our heart's content. But that's what caused that rally. That was the opening bell in New York City or in Chicago. Remember, we're in Chicago over here. We have a little bit different rules, but we're trading the same market. This is the Russell 2000 over here in the futures market. And we just look at that thing down $225. That's not good. This one here is $20. I'll tell you what we did yesterday here in just a second so we can kind of go through and review. Let's watch these markets take off a little bit. There goes the Dow. There's a buy signal right there for us. We just missed. I guess we could chase the market if you wanted to. I don't really want to chase it. See what it's going to do on a break above that high right there. That's a little pullback. Breaking above the high. See if it won't continue. This down here, this Russell's only a 1-minute chart. That's not a range bar. This is a range bar 20. So range bar, of course, means that the market has to move 20 minimum moves before it'll create a new price bar. This one here has to create 6 minimum moves before it'll create a new price bar. This is a micro mini, so it's 10 times smaller than the mini. The mini's a little bit larger. And there it created another little red to green right there. It's trying to move higher once again. So that first one didn't move out very well. It's losing a little bit of mojo. Let's see if it can kick up there a little bit. Again, these are our options left over from yesterday. These are just a couple of, oh, that one was profitable. Should have taken it off when it was profitable. These were our insurance policies from yesterday's trade. And there's just a couple of straddles that we put on. A couple of at-the-money straddles. And so we're just going to let them, there, that one's coming back into, you know what? If it comes back down into nothing, that's good for me. We'll just kill it. Let's liquidate that multi-leg. And just get out of that thing. We'll let this one run a little bit, see if it won't calm down. It was only down $75 before the market opened. I think the implied volatility ran that thing through the moon to the moon. We'll let it calm down a little bit. Look at that. There's another little red to green right there. That's another little scalp. Those things aren't moving very far, are they? The market's not moving very far before it wants to kick back. Take out everybody's stops, trying to trail them up, stop them out, go up, stop them out, go up, stop them out. The S&P on that 2-minute chart just keeps going straight up. Trying to see if there's not an opportunity for us to put an order in. Take a little bit of money off the table right here, but I'm not seeing anything exciting so far. Yesterday was an absolute miserable day. Boy, I'm telling you, it was the most miserable day. Actually, it was pretty good for our options. It was good for our options because we sold options premium, right? And we collected the premium. But bad for our other strategy, our hedging strategy. Got our heinies handed to us on our hedging strategy. So we'll have to talk about that here in just a minute. Let's just watch these markets for a minute. See if, oh, look, there's our red to green right there. That's a little better pullback, so that gave us a little bit bigger move. Let's try it again. Is it going to go up or down? Let's see if we get one more. Red to green. Watch on the red to green. I try it on. It's not going to work. It's not going to go up. Come on, red to green. Bounce off that 100. Oh, that's the 50. 50 period moving average right there. Okay, we're long. Put our stop in there. Just drop it in there just in case we're wrong. Now, rally a little bit. Come on, buddy. Rock and roll for us. It's going to go far enough to even get to break even. There, we're at break even. All right, so we'll see. Let it go. Nothing we can do now but sit and watch. It didn't go anywhere. What do we close out? It was a whopping $25. Better than a stick in the eye. That was a single contract. All right, single contract. $1,000 investment, made $25 on that little run. Oh, look, NASDAQ's down here, trying to move down lower again. They're rotten NASDAQ. That thing killed us yesterday. Holy cow, that thing just destroyed us yesterday because it went nowhere, and we had a hedge on that VWAP line right there. So we said if it's below the VWAP, we're going to take a short position. If it's above the VWAP, we're going to take a long position. We're just going to let it go. And it just went back and forth and back and forth and back and forth across that VWAP. Just wiped us out. All day long. Didn't move past the VWAP. Never left the VWAP. All day. Seems like a simple strategy, right? Well, we'll just go long above the VWAP and we'll just hang on to it. Or we'll go short below the VWAP. Just hang on to it and see how far it goes. Damn market just went back and forth across the VWAP. Never did leave the VWAP. And we had it on autopilot. So the computer just said, okay, long, okay, short, okay, long, okay, short, okay, long, okay, short, okay, long, okay, short. All day long. Stupid market was just absolutely dead yesterday, which was good for our options. I'll show you that. Oh, look, we're back down to, things are calming down. Look at that. We're back down to the $75 where we were before the market. That's good. We're going to kill that one right now. That's a good loss. We'll take that loss. That's just our insurance policy from yesterday. We had anticipated. It's rare that that thing makes you money, but it's that's how we can subtract that off of our account. From we actually need to subtract that from yesterday, so we'll go do that. Let's go in, and now that we've taken those off, oh, look at these things now. Now we're going green to red, green to red. We're in the downtrend, so we need to go green to red, not red to green. No, we're trying to turn here. What's this thing doing here down on the NASDAQ? We're below the VWAP. Should try to take another short position here on another drop. Let's try that before we go do our review. We'll do one more. Just see if it'll drop one in here. See if it'll fall. How far is it going to go up? Oh, it's going to go all the way back up to the VWAP again. It's going to cross that stupid VWAP a million times. Back and forth, just like yesterday. Well, it's a little bit deeper into the green. Let's see. Oftentimes when you get a deeper green, you get a deeper red. So we'll see if it'll turn around here. Hit the VWAP and turn and fall. I'm just trailing one price bar up. I got that those settings in the QOCO. Here, I'll show you what they are. Add new QOCO. Let's see, which one am I doing? I'm doing 1. There we go. We got that filled. I'm going to show you the settings so you can do it yourself. And I'm just going to drop this in here, and then it'll start trailing down one price bar back. If it turns and starts to go back up, it'll stop us out. Stopped us out. Here, I'll show you how I did that. So we're going to go 1 right there. That's my settings. That's how I did that. I just trailing one price bar back up. I got no stop. I got no limit. And then I just put my own reversal trailing in there. So that market's changed from bullish to bearish. Now it's starting to go back up again. You think it's going to turn and go back down? I don't know. You got 1 drive, 2 drives. We're in the second drive back up. It hit that 200 period moving average. We could try and take a short off of that. It's a micro mini, and we're only doing 1, so it's 1/10 the size. Not taking any risks here. So it shows we're down $117. That's because we took our insurance policy off from yesterday. We'll go look at that here in just a second. Let's play with this market a little bit, see what it's doing. Put our stop in. Don't take a big risk here. Just let it go. If it wants to go, let it go. If it doesn't want to go, just get out. Let it rip. Nope. It's going to try and go for a third drive up. Drive 1, drive 2, drive 3. Drive 1, drive 2, drive 3. Let's bring that full screen so we can see what happened before. We had a nice downtrend. I thought we were going to catch another downtrend. This thing's reversing and coming back up. So now we're getting an ABC pattern out of here. A, B, we're getting that third drive up in here. Bouncing off the 200 again. There's our signal to the short side. I didn't take it. We'll throw one in there right now. See what it does. Come on, you rotten little dog. Now it's not going to do anything. It's going to die. Put our stop in. Oh, that thing just went up again. Not getting anywhere, are we? $4, $2, $6. So not breaking the bank on us. Just trying to be right. There's another one right there. Green to red. I think that thing's going to go down. Broke a high right there, that 200. Lost its mojo. If it breaks below that, we'll put one on. Put our stop in. All right, keep her rocking and rolling there. Keep her going, buddy. Keep her going. Okay, we got to break even at least. No, didn't want to go. Didn't want to go. It's going to go now. We'll try it one more time. One more time on the little pullback. See if we can get a drop out of there. I want another one of these things, just like that. That would be nice. Test that high. Breaks above that high, guys. You're going to go long on that break. Oh, can't even draw a straight line, man. Draw a straight line. There you go. I don't think they're going to make it, though. Come on, buddy. What's it going to do? What's it going to do? What's it going to do? It's testing that high right there. If it breaks above it. I don't like to get in on the break, on the initial break. If it goes high, I wait for it to go up and turn around, use that as support, and then that's where we'll get in right there. Otherwise, we'll take the short because it failed. Failed a second time. All right. Just put our stop in here, break even. Just let it sit there for a minute. Let it soak. Let it soak. Come on, rock and roll. Come on, NASDAQ. All you can do is be cheerleader now. Just cheer. Rah, 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 NASDAQ. Rah, 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 NASDAQ. Come on, you rotten little dog. Soak it up, soak it up, soak it up. No, it says, I ain't going to go nowhere, Lan. I ain't going nowhere. Just going to bang everybody in and out of the markets. That's what I like to do. When you're trading the micro minis, you're just trading proof of concept. Just see if you can do it. See if you can pick the right markets, run the software correctly. Micro minis are kind of tiny, so not going to rip your wheels off if you're wrong. And then you take the same strategies that are working for you in the NASDAQ. Once you get it down, you go over and go into the mini contracts. Got stopped out again. Well, let's go review what we did yesterday. We tried to have a little fun here today, and the market's just not participating. It's not participating. Wow, look at it pop across, and look at the Dow popping across the VWAP. All those little arrows are back and forth across the VWAP. That's what happened to us yesterday. Let's pull up these charts. Let me show you. So this is where we started out yesterday. I got a bunch of screen captures. I don't need to show them all to you because. So this is a screen capture of yesterday's setup. So that's kind of how we started out. Okay, so this is where we put in our orders. The market started to move on us a little bit. I added actually in a second one. So we put the first one on while you guys were here in class. And then I added the second one. And both of them paid off yesterday. They both did pretty good. I'm happy with what we did with our options yesterday was a good deal. It was the hedging that kind of screwed everything up for us. All right. So it was the hedging. And so that's how we started out. So we were up 322 on that one. Let me go show you the the hedging. This is just another one halfway through the day. I just took a whole bunch of screen captures. Look at look at this. What happened there? Look at this nasty thing. Look at that nasty. That is a nasty. What happened? Come on. Okay, look at that nasty. This is what happened to us on the NASDAQ yesterday. Can you believe that? This is what happened to us yesterday. All it did is go back and forth across that VWAP all day long. And every time it went across the VWAP, it lost 24 bucks, 25, 23, 22, 20. It just kept going back and forth across the VWAP. Now, the problem with that is when you get your arrow, it has that little bit of slippage. It's not perfect. It doesn't come in exactly at the purple line, right? You have to have but it's only, it's 20 ticks. It's 20 ticks on the NASDAQ because we were on a range bar 20. So you can see up there let me see if I can slide this over a little bit. You can't see it because my face is in the way. Bring that over. There you go. See that? It's a range bar 20 right there. So that's the distance between the top of one price bar and the bottom of the other. So when the market crosses that purple line, well, it's got to go past that purple line, and then the 20 tick bar has to close below the line, and then it gets an arrow, and then it fills you. Well, then the market goes down, and then it turns around and comes back up, and then it has to go across that purple line. The 20 tick bar has to close above the line, then it gives you the arrow, and then it fills you. And so that's what happened is it's just got that little tiny gap, $20 on this one. Now, if we were on the mini, this is a micro mini. If we were on the mini, that was a $245 gap between the entry and the exit each time we got in and out of that NASDAQ yesterday. And so I handed us our heinies. It's a heiny hander. So that was not good. And Michael Bruce says we're losing money hand over fist with that one. Yeah, that's not good. So we got to come up with a better strategy. Well, or we got to have a market that moves away from the VWAP, right? I mean, that's the whole idea. We just want the market to move away from the VWAP. And yesterday, the market was absolutely, completely, and utterly dead. It did not go anywhere. Just completely sideways. So it did nothing. I mean, if the market moved away from the VWAP, it wasn't such a bad strategy, but the market just wouldn't leave the VWAP yesterday. So we have to be very mindful of the fact if we're going to use this type of a hedging strategy, that we have to have it. The reason we put on a hedge is because we're going to be trading in a very liquid market, a very active market. Of course, if we're going to be doing this as a hedge for our option that we're doing our wild eye, crazy eye, iron butterfly, we don't want to be selling the damn thing in the middle of a very active market anyway. So then you have to start saying to yourself, well, why are you hedging? That's only if the market you anticipate is going to be very active. And you're like, well, if I anticipate the market's going to be very active, why would I put on the wild eye, crazy eye, iron butterfly anyway? I just shouldn't put it on. So you shouldn't have to hedge if you're going to do it, because you shouldn't be putting it on in a time where you think you're going to have to hedge. Okay, well, the problem is sometimes we think the market's going to be quiet and we put on our neutral option strategy to collect premium, and the market takes off and runs anyway, even though there's no news. There's no news that we're aware of, right? And so that's what happens. And so that's why trying to come up with a nice hedging strategy. And I thought the VWAP would be a good hedging strategy because, hey, what's the chances of the market just bouncing back and forth across the VWAP? Well, apparently, on occasion it does that. Okay, let's look at the next one, because we hedged two markets, right? We did the NASDAQ and we also did the Russell. And here's the Russell. So here's the hedge that we did on the Russell. Bring that up so you can see it. And so here's our Russell hedge. Now, this one wasn't as bad because the market actually did leave. You can see down here, blow it up a little bit. The market actually did leave the VWAP yesterday on the Russell. So the Russell actually trended a little bit. It did go back and forth across the market. Now, that $200 one, if you remember, I put that on manually yesterday. That was me. I was worried the market was going to take off and go and not go back to the VWAP. Head itches. So I put that on manually, and then it went up, and the VWAP flipped to the other side, and it cost us $200. So that was my manual mistake. But if you remember, we also put one on the Dow, right? We turned on the Dow to hedge the Dow, and what happened with that one? Well, I didn't manually get into the Dow to try and start the hedge. I was going to wait for it to cross the VWAP, and all day long, the Dow never once crossed the VWAP. So yesterday was kind of a strange day. The NASDAQ crossed the VWAP 42,816,922 times. And so we got our heinies handed to us, and that was in the micro mini. So that was a really bad hedge. This market, had we not put on the manual hedge, would have probably at least scratched and broke even, or maybe even made a couple bucks. 270, 320, might have made $100. Who knows? But probably, I mean, it looks like that would have made about $100 had I not manually put on that $200 loser. But then we didn't put on a hedge on the Dow, and we didn't get a single trade because it never did go back to the net. I mean, it never did touch the VWAP. So that's kind of a strange thing, isn't it? Dow never touched the VWAP once. Russell touched it 3 times, 4 times, 3 times. Actually touched it, crossed it 3 times. 1, 2, 3. Yeah, crossed it 3 times. And then I closed out 320. That wasn't the 320 was at the end of the day. I just closed it out, right? Took the profit, whatever it was. That's not crossing the VWAP. And then the NASDAQ, man alive, we got ripped a new one. It just never left the VWAP. So that was kind of a weird day. But it is what it is. You know, I don't make the markets move. I just turn on these tools and see what they do. We learn. That's what we're doing here. So let's bring up our spreadsheet, and I'll show you how we had to come out with our spreadsheet. Now I have to put in, we got one more addition we have to put in here. Not today's day trades. We want to put in the 2 losers that we had. One of them was the S&P. Oh, both these were on the S&P. So we go to the S&P, go to the chart. Today's loser, 137.50. So those were our 2 insurance policies for our 2 options that we put on yesterday. So let me bring up I put on one while you guys were here in class. And then here's an interesting thing. I was watching this stupid market yesterday, right? And we put on this option trade on the S&P 500, and it was an iron butterfly, right? It was our wild eye iron butterfly. And I was waiting for that thing to decay. And you want it to, we know, here, let me pull up my little chart here. We know that as the market starts to decay, time decay, it takes a while and it starts to decay towards the end, right? We know that. We got a little chart here. I'll pull it up for you so you can see the little curve, the little bell curve. But most of us know what I'm talking about. It's that little bell curve where, I changed the sheet. And I moved all the option stuff to the bottom of the sheet. Where's all my option stuff? And then, of course, I had it in there 2 or 3 times. So I had to get it out of there 2 or 3 times. All right, so here's our little sheet. All right, and so introduction to theta. We know that theta decays more slowly in the beginning of the morning and then more quickly in the afternoon. But man alive, I'm telling you, it was hardly this is hardly a representation of what it did yesterday. We put it on and it was like what, $800, I think, or something is what we collected and it was still like 1 hour before the market closed. That damn thing was still worth like $500. We'd only made like $200 all day long. It took all day long. It didn't decay until like it started to decay about 2 hours before the market. And then 1 hour, it was still had, I couldn't believe it. It just, the decay on it was so slow. So that's why I put on a second one. I'm like, here we are at noon, 11. We got 2 hours till the market closes. And we've still got more than 50% of the value in this stupid option that's supposed to be decaying over time and give us the time decay. And it's hanging on to its premium. I'm like, why are you hanging on to your premium like that? That's not fair. Cut some premium and let us have it taken off the table. But no. It wanted to hang on to its premium right up until, it was 2 hours before the stock market closed. Now remember, we still got the futures market that closes at 3 o'clock, so an hour later. So it was 3 hours before the futures market closed, 2 hours before the stock market closed, and that damn thing still had 50% of its value. So I put on another one. I'm like, well, screw you guys. I'm going to take another one out of here. I'll put that on there and make you give me another $500. And so I did. So that's why I put the second one on. That's why we had 2 insurance policies, because I added a second insurance policy. So I took that off. So we had actually a pretty good day yesterday. We ended up with $862, you can see. But we have to subtract our insurance out of that. So our insurance policy was $137.50. So we have to subtract $137.50. That's why when we first turned on the market and the implied volatility shot those things way wide, and we went from having a $75 loss to 75 combined. That was both of those insurance policies combined were $72 before the market. I could have closed them out at 72, but I wanted to do it when you guys were here. So then when I waited, and it was like, what? It went all the way up to like $500 loss. The implied volatility took that thing to went crazy on us. So then when I was able to get it off about 118, I was a little bit happier with that. So I should have closed it out when it was down at $75. Good lesson to learn, right? All right. So we have to take 862 and subtract 137.50. So let's do that. 862 minus 137.5 equals. So we made 724.50 yesterday on this option. 724.5. 724.50. That was because we did 2 of them. We did the first one in the morning, made 500. The other one did about 300. And then that's what happened to us with our hedging. So we got our Heine's hedge. Heine's handed to us on the hedge. Let's bring that up. I'll read you what I wrote. I basically told you what I wrote, but I'll read it to you. I'll show you. These are my notes on here. How come that thing won't let me see it? There we go. Oh, there we go. That's better. All right. Here's what I said. I said, turned on the autopilot to hedge the VWAP. Did this on 2 markets. I actually did it on 3, but one of them never did touch, so it never did count. So we just did it on the 2 markets. We hedged the 2 markets. NASDAQ Micro lost $434. This market was utterly dead. It just went back and forth across the VWAP all day. So then we have the Russell 2000 lost $160. This market bounced across the VWAP several times, but never moved away from it far enough to even regain the losses. So the problem with this strategy is the slippage on entry and exit is pretty wide. When the market crosses what happened? Come on, Microsoft, give me that back. The problem is when the strategy is the slippage on the entry is pretty wide. When the market crosses the VWAP, the loss from the entry to the exit, although seems like it would not be much, actually is rather large loss. Taking several of those losses is painful and difficult to recover. It's the problem with the chicken and the egg. We tighten down the slippage by moving to a smaller time frame chart, but then we accumulate more whipsaw trades. Further out, less trades, but we end up with larger losses. For hedging, I think the magic stick might handle that a little bit better. The whole strategy relies on whether the market trends away from the VWAP or not, and how quickly. I've been having better luck with the at the money 1 DTE straddle as our protection. So we were doing the Delta 20s, remember? And then we were going out 25, 30 days. And that seems to work pretty good. But if the market moves, it doesn't do any good because that's worthless insurance. All we're really putting that on when we go to the Delta 20s is just to reduce the margin. So when we do that, that's great. It's wonderful. Doesn't give us a big loss that we have to pay for, right? It's not an expensive insurance policy. The problem is when we do need that hedge, we've been trying to hedge with contracts, and that's not been working for us. We've not been able to consistently get good hedges because the market never moves. It just goes back and forth, which is what's good for our options. So our hedges always take away all the profit from our options. So I've been putting on the at the money straddle, right, with only 1 day till expiration or 2 or 3 days till expiration. And that's been actually working better. And we've got that documented in Pit News Magazine. All this stuff we've been doing. I've been taking all these notes, writing them all down in Pit News Magazine. Pit News Magazine has that, and it's got a supplemental to the article talking about just that exact thing, where we're going from the wings out at a Delta 20 down to an at the money. And I think the at the money over the long haul is turning out to be a better strategy than the Delta 20. Just because when the market does take off and run, you got better insurance. Now you have to pay a little bit more for it, but it's not that much because we're going a day out and the theta doesn't decay. As I just talked about, in that first day, that data isn't decaying, and so of course the value of the options aren't increasing or decreasing either, but that's what we want, right? We don't want that insurance policy to change much in value. We just want it to hang on to its value for the next couple of days, because we're only going to do the 0 DTE on the sold options and cover our heinies with the at the money straddle. At the money, it's a strangle. No, it's a straddle. At the money straddle. Straddles when they're on top of each other. Strangles when they're apart. I know it's backwards. Okay. So that is what happened yesterday. And that's where we sit. So we ended up with $724 on our options, down $595 on our hedging. And we got our heinies handed on the hedges. So we're not going to hedge like that anymore. Well, we can try it some more, because if the market would move away from that VWAP, it would do a good job for us. It's just getting it. If we're in a dead market, which is what we want, right? That's why we're putting on a neutral option strategy to collect the premium. But look at this. This is all we've been doing this whole month. This is all of our options that we've been selling options premium. Those are all iron. Those are all wild eye, crazy eye, iron butterflies. Every single one of them. $10,000 so far this month on wild eye, crazy eye, iron butterflies. Now, I've not been putting every single one of these in my real money account, but I've been doing pretty good on my real money account. I'm not up 10 grand on my real money account, but I'm doing really well on my real money account with these as well. Not as good, but I haven't been doing as many either. So in the classroom account, we've done one every day, right? Almost every day we've tried to put one of these on, and we've actually done pretty good. We had a little run there where the market actually trended. Remember that? And I think we were doing Delta 20s on those. Do we have notes on that? Because I bet, let's see. Wild Eye, Crazy Eye, Iron Butterfly. This loss didn't have to happen. I made two critical errors. First, Wild Eye Butterfly, loss of the month. First, I took off the first profitable trade at 30% profit, 312. Since we were still delta centered at 25%, that was a good trade, textbook perfect. All right, what happened? The second was the mistake. I put on my second sold call, put at delta center, and walked away. Forgot to put on my target. Might take profit at 25. First mistake. Third mistake, I was busy, had a business meeting, went way over schedule, and I came back and the market had moved so far outside my range I couldn't get back. Had I been at the trading desk managed position, I think I would have saved it. My insurance policy made me $50. Not enough. Now that's what I didn't write a good enough. Would have been better if the at the money insurance. Oh, so see, that was what I was looking for right there. That was a Delta 20 insurance policy. Had we had the at the money insurance premium, I think we'd have been better off. Even though this is just a demo account and the loss is still painful, proving that we need to stick to our rules and be prepared to mitigate a dead market that turns active unexpectedly. I think the bigger lesson on that day, on that loss, was that we were using the Delta 20 options as insurance. We should have been using the at the money options. And I made that little comment right there. Would have been better had we been using the at the money insurance premiums. What about this one? Took a loss on the sold option due to the market moving like a wild man. So that was just went straight on. We just lost on that one. Didn't leave many better notes in that. We had a good. Oh, some guy stopped by. A Russian guy stopped by and told us to go trade silver. We'd had a good day on silver that day. This was our stock options. But those are our two losers all month on our Wild Eye, Crazy Eye. So, and then this was a hedge. We were trying to hedge it. And we did another couple of hedges in here too. I can't remember. So that's where we're at right now. We got what? Today's what's today? Today's Thursday. That was yesterday. How are we turning out so far today? Down 124, but we already took that into consideration. So that was that one. Let's go charts. All NASDAQ. We lost $11.50 on the NASDAQ. Did we trade anything else? We didn't trade anything else, did we? So we're down. Oh, wait, that one says we closed out a $25 trade on that one. 12, 12, 24, so about 25 bucks. Let's just throw that in here while we're here with our spreadsheet. So made a whopping $25 today so far. All right. It's green. All right. So that's the review of what we did with our Wild Eye Crazy Eye. Are we going to put another one on? Let's go look at the news events. Before we do news events, let's go say hi to some people. Let me get me down here. All right, Bruce R. coming in number 1. How you doing this morning, Bruce? Great to see you. Kirk Schwartz coming in number 2. Nice to see you, Kirk. And then we got Truly Calm. Truly Calm. Good morning. You're coming in number 3. Nice to see you guys. Top 1, 2, and 3. We got Michael Bruce coming in on the 4th place. Not that it's a race, guys. Not that it's a race. And then we got Truly Calm back from Africa. I missed out 2 man videos. I booked yesterday, Trade Miner database again. Great, cool, BR Oliver. All right, so you had a good trip to Africa. You're going to have to tell us how that went. Did you see any elephants? Did you go to the reserve? Michael Bruce, the day the market is actually moving, I'm not at my trading desk. Well, it did move a little bit this morning, but not too much. It's kind of dying out here, Michael Bruce. I'm not sure you feel too bad. This is losing money hand over fist, Lan. Wait a second. Are you talking about me or you? You? Brian Johnson. Good morning, Brian. It's good to see you. Anybody else? We got some more guys in here watching. If you guys want to throw up your little marquees, we'll make you famous. All right. So there's where we kind of sit today. Let's go look at our stock options. Should we? Let's go look at stocks. I'm going to bring up our stock options review. We're going to look at our stocks portfolio. All right. And there's I got a little secret I want to show you. I want to teach you tomorrow. Okay. So it's going to be in tomorrow's lesson, but there's a way that you can tell whether the industry is bullish or bearish. And I want to show you that tomorrow, the whole stock market, whether the whole stock market is bullish or bearish on the market, whether they're scared or afraid, the fear factor. We're going to play fear factor. All right. So, all right, let's come in and see how our portfolio is doing. We got everything open. Let's go see. Control, all right, click, open chart. Looks like we got everything open. All right, let's just start at the top. Bitto honey. This is Bitcoin. Give me a second. I got to drink some tea. All right. Let's go put this up here. Let's see. Where are we going to put me? Hide me. You can't see the chart there. I need to do that middle thing. Who was it? Said I should go in the middle. All right. So here's what we got. Oh, don't peek down there. Don't look at that. Don't look at NVIDIA. Don't peek at that one. It's a secret. Guess it's no secret now, is it? We're kicking Heine on NVIDIA. I'm doing good in my real money account with NVIDIA too. Happy with that one. So Bitcoin. Do we want to buy some Bitcoin? This market's come down. Made a nice little pullback on this nice run. Little 1, 2, 3 ABC top formation. Right? Up, down. That thing has gone all the way, whoop, just like that. All the way down to 161.8. And now it's starting to rebound and come back up. So it bounced off the 200 period moving average down here. And it looks like it wants to rally once again. So I bought a little bit of Bitcoin right in here. I'm doing pretty good on my Bitcoin, real money. And so now we're looking for this thing to bounce and go one more time, right? We want to see it make another. So this is our first drive on our fractal. So a little pullback. We'll go look for a B, maybe a little pullback on our fractal. We don't know. It might hit the blue lights and flush. Could do that. But I'm looking for it to continue higher. It's not going very exciting, but let's come in here to our options and see what we've got. Let's come down here to a 100-day option. It's $200. Volume sucks today. Ugh. Well, some people are buying this one down here today. They're buying the in the money. I don't want to buy an in the money. Huh, that's weird. They're buying the in the money. The volume's nothing. What's the spread? $51? You got to be kidding me. Let's go to 50. What the heck? What the heck, guys? Volume's nothing. Oh, some people are buying the out of the money. Oh, look at that $3 spread. That's better. Let's get that. Let's get a few of those. Buy. I wish I could get the in the money. $53. What the heck is that? That's unbelievable. I don't know. I want to get a little Bitcoin here. I think we're going to go up on the Bitcoin. There's 10 of them, $800. We'll put $1,000 on there. All right. So we need to go, since we're buying, we got to go to the ask. It's 88 cents. Okay. We got our fill. Would have to pay $5 on the spread or something. Okay. That's not bad. Don't feel bad about that. Okay. So that's our Bitcoin. We got our DuPont in here. DuPont's up $110, but it's been really lazy. We're in the money, though. We're on a B3. What do you want to do with that land? That's just some dead wood that's hanging in there. DuPont's not going anywhere. It's trying. I think that was a Kramer versus Kramer. Wasn't he in there? He's the one that told us to get into this. We still got 50 days left on it. We're up $110. Let's just leave it in there. How about Dell? Oh, Dell looks like it's peeking out up there. Wants to flush back down. We're just going to take our profit off on Dell. Liquidate that one. So we're going to take that one. We've got to do a 28.60. 28. Ooh, look at the spread. I don't want to have to pay that. Liquidate. Oh, man. It says the spread down here. Oh, that's the 1 day. Let's go see. 50 days out. That's a miserable trade. What the heck? Look at the spread on that thing. $160. To take that off, take our profits. That's because they know the market's going to flush. Oh, damn. They're going to make you pay $150 to get out of that thing. Why? Because they think the market's going to flush. They don't want to give you that money. Ugh. 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 Well, you could lose $150 in the spread to get out and take your profits, or you could lose it as the market flushes back down and take the loss and then get a tighter spread when the market turns and starts to go back up again. This is a trade. This is not a investment. So we're up $1,500. We have to give up $140 to get out of this thing. What are you going to do? What are you going to do? What do you want to do? That's a rotten idea. Rotten. Oh, look at the spread change on this thing. What the heck is going on? There's zero volume on that option. I don't know what they're going to do to us to get out of that thing. That's sitting at 220. That's what happens when you trade a market that's got no volume. Of course, it got lots of open interest. Look, it was a good volume day when we bought that thing. Now it's, look, that option is just dead. Completely dead. Now it's back to 120. Liquidate. Can we get out of this thing for 120? $29.40. If we were in the real money account, you just place your order and they'd take it right there. Well, I don't know if they would or not. They might not even in the real money give you a midpoint. We're going to go down. 28.80 is, they're going to make us go all the way to 28.80. Look at this, 28.80. That's 128. To get out of that thing, $170. It's going to cost us $170 to close this position out. Oh my hell. Well, I don't trust it to go higher, not with a bar that looks like that today. So I paid it. I paid it to get out. But we ended up with 1560 instead of 17. 15, yeah, it was almost 17. We paid 100. Wow, that was nasty. Well, that's the name of the game. Nature of the beast. Look at this one. Meta. Not good. Not good. We're going to kill that. Liquidate. Take our loss. We're out of it. How much we lose on Meta? $930. Wow. It's coming in. I don't know why I took that in the first place. Who told me to do Meta? Doggone it. Was it Kramer? Let's blame it on Kramer. That was an X1S A1, which is almost no profit at all. I mean, there's the probabilities of that thing paying off is almost nothing, almost zero. Why did we take it? Because we got a little bit of a bump in there thinking that we were going to jump on that thing, but it looks like it wants to break those blue lights and flush. How far down is it going to flush? Nobody knows, but it looks like it's going to hit those blue lights and flush. Might only come down to the 100 period moving average, but it could come all the way down to 200 down here. So we'll try again. If it gets down here, we'll try and go long on it again. Meta's been doing really good. It might not do it. It might turn and take off tomorrow, but who knows? We got out, took our loss. It's not going anywhere. So NVIDIA, we got into that one. We're doing well. Can't complain about $14,000. How many of them do we have? One. And it's still going up. It's a trade, Lan. It's not an investment. You're up 15 grand. You got your class here. Take your profits. Well, it's still going up. I know. You can put on another one. You can put on another one. But I already got one. I already got one. $25 to get out of that thing. Take our money and run. We got 22 days left. I'm going to take it only because you guys are here, and I want to close this out by the end of the month. I could close it out tomorrow, but we might not be looking at these tomorrow. Tra-la-la. Says I bought rough diamond with this. I make money. Oh, tra-la-la-la-la. You went down to Africa and bought rough diamonds? Since you're losing it in your trading, huh? That's pretty cool. I want to go to Africa with you next time. I'll go buy rough diamonds with you. That sounds like a fun trip. We shouldn't really sell this. It's making money. It's moving forward. I just want to take the profit. I want the profit. I don't want to wait till it loses half of it to give it back, but it could keep on going. What do you want to do? Cut. It's the end of the month. I want the money. We can put it back on. What's this? 1, 2, 3, 4, 5 bars. Usually we get 4, right? And then we get a little pullback. If it gives us 1 bar, 2 bar pullback, we could put it on again. We could take it off right now. Let's just take it off. Let's just take our money. I know it's something you shouldn't do. You're supposed to hang on. Hang on, Lan. Diamond hands. Hold on for the long haul. But I want the money. I want to just take it right now because you guys are here, and it's fun to take profits when you guys are here. So let's go ahead and do that. How do we do it? Just right click on it just like that. Say liquidate the option. And since we're liquidating, we have to go to 214. 214. We just mark it out of this thing. But let's go look at it. Oh, my hell. They're not going to do that for us nicely. They're going to charge us. Look at that. It says down here the spread is $20. Oh, that's one. Oh, we got to go out to 22 days. Spread. They said this. They're saying the spread is $50. That's at the money. Where's our option? We're in the money. Oh, that's 22. Oh, yeah, we got 22 days. Where's our option order? Oh, that's calls. Yeah, that's calls. Calls. What is that? It's a 945. Where's our 9? Oh, we're deep in the money. There it is, way down there. Look at the spread. $255 to get out of that thing. Oh, my gosh. Oh. Holy smoke-a-roonies. Look, one above it's 135. Why are they making us pay them $220 to get out? That's a dirty trick. Well, you're up $14,900, Lan. You're whining about $200 to get out? Yeah, I'm whining about $200 to get out. They put a $200 spread on that thing. That's a dirty trick. $180. Gee, my Christmas. $214.45. $155 what they're going to charge us to get out of this thing. You rotten little buggers. That was a dirty trick. All right, what about this one? Same here. We're going to take this one off too. This one is 22 days. It's right there. It charges $40 to get out of our $700 position. All right, let's take it. $11. That's why you want to bid for it. You're in the real money account. You can bid for these and you get better prices. But when you're in the demo, they make you go all the way to the bid or the ask. So to get out, it's $40 is going to charge us. Yeah, it says $40. That's okay. All right, that's not too bad. We're up 7. Receive. How much do we get out of? Well, closed. Chart. $680. All right. How about premium resources? Now, that's a put option. Okay, it's starting to bounce off of that 100 period moving average. Let's just take it. Let's just take it. What are they going to charge us on this dirty bugger? 78 days out. Let's go to 78 days out and see what they're saying on this. Oh, this is puts. Look at the puts. $25. 120. Oh, that doesn't. Oh, $1.20. Look, they're saying that the spread's $250 wide. They're going to charge us $250. It says down here $30. It says in there $30. But up here it's saying spread is what the heck? That doesn't make sense. Why are they going to charge us so much for that one? Wait a second. Now we're losing money. Total gain. I thought we were making money on this one. How can we be losing money? Total gain, minus 175. This is a put option. We're losing money. I thought we were up on that one. Did it just go? What happened? They saw we wanted to liquidate it. What do we lose on that? $950 because of the spread. We had quantity 10 of them. What a rotten deal. What's going on here, Lan? You got enough chopsticks. We're on a B1. We're up $1,000 on our TJX. We're getting our heinies handed to us on exiting these things. Expiration 50 days. Where are we at on this thing? This is a call. 10 of them, $500. Spread's $15. Well, that one shouldn't. Well, wait a second. How many of them do we have? 10 of them. We have to pay $15 to get out of each one of them. Yeah, we're going to take most of our money away from this one too, just getting out on the spread. $80. That's at $497. We go down to $490. We're going to lose $150 getting out of this damn thing. But it's still on the rise. Trying to break above that high right there. Let's just clean the slate. Let's just take that thing off too. All right. DuPont. You know what? Kill DuPont too. Liquidate. All right. So the only thing we got is our Bitcoin that we put on. We put on Bitcoin. Okay. All right. There we go. We cleaned the slate out today. Let's go closed positions, closed chart all. 16,150. Where's our spreadsheet? $16,150. Today's Wednesday, right? The 30th. Right here. Option stock. 16,000. Oh, short-term memory. 16,150. There we go. We kicked some booty on that one. And then see, we were scared about this one. And I was like, we cut the dead wood from our forest. We have some big winners we're hanging on to. So this looks bad today, but wait until we close out our winners. Smiley face. 16 grand. All right. So that's pretty good. I feel good about that. They will feel good. Now, whatever you do, don't go back and look at them and say, if I would have hung on, I would have made this much money. Okay. You can't do that. Don't do that. So that's a big day for us. Today's Thursday. Let's come in here. We're going to mark this as our biggest winning day. So we take our money from the futures market, take it over, put it into the stock market, and we trade it over in the stock market. That's what I like to do. I'm not telling you what you should do. I'm just telling you what I like to do. Okay. The font on that one should be black. All right. So we got our calendar all set up. That's our biggest day, 16,150. We got 16,699. How does that work? Doesn't seem right. $16,699. Oh, because of our 2,000 here. So that's right. Okay. And that's the sum of this one, 10,000. So we've made $10,000 this month so far on our Wild Eye, Crazy Eye options. We've made 16,000 on our stock options, and off hours trading. That's just other class members, 1,200. And on this lousy day trading stuff that we play around that first hour while we're here, $495. That's not been the greatest. Not been the greatest over here on this futures day trading stuff. $500 is better than a stick in the eye, right? Okay, there we go. All right, guys. Tomorrow we're going to come in and we'll I want to show you the volatility stuff tomorrow, and then we'll go through and we'll Bruce is down here. Take the money, Lan. Take the money. Bruce says, take the money. We took the money, Bruce. All right. So tomorrow we're going to look at the volatility stuff. I want to teach you a really cool trick on volatility. It's something you guys need to know if you're going to be trading options in the futures and in the stock market. And we've been doing some of that, so we need to look at this strategy that you need to be aware of. So make sure you come back tomorrow, because that's what we're going to do. And then we're going to see if Kramer sends us an email and tells us what to buy, or we'll go through and look through some of these Doc Brown stocks that he sent over. And we'll have a list of stocks to look at tomorrow. And we'll go through and do some comparisons. I also want to do a bond strategy with you. I got something really cool to show you about. I have students at the university come to me and they're like, Lan, I don't have any money. I'm 70 years old and trying to retire, and I don't have any money. What do I do? So I'm going to show you a couple of tricks you can do. All right. How you can retire with no money. It's a good idea, right? We all want that. How do you retire on no money? Show you. Okay. So we're going to do that tomorrow too. And all right. I guess that's it. If you guys like today, I got a Sunday school lesson for you. I guess I'll do the Sunday school lesson. Sunday school lesson. Don't revenge trade. All right. If you lose money, don't try and win it all back in the single trade. All right. You should be using really tight stops anyway, especially when you're day trading. Use your really tight stops. I know people tell you, don't use such tight stops. Hold your stop back further. All that does is just makes you lose more money when you're wrong, and then you have to recover it. I like really tight stops. I've always erred on the side of caution and had really, really super tight stops. And I know I get knocked out a lot, and the market then turns and goes in my favor, and I would have made more money, and I know all that argument. But I hate losing money so much. I would rather not make money than lose a bunch of money. All right. I can always make more money. There's plenty of opportunities in these markets to make money. But if you take big losses, you're not ever making money. You're just trying to recover your losses. And that's a bad place to put yourself. So I go against traditionals. That's just me. I'm not telling you what to do. I'm just telling you what I do. And I caution on the side of error, on the side of caution. I would rather get knocked out with a little tiny loss and lose the opportunity to make a bunch of money than to hold my stop back and take a bunch of big losses that I have to then recover from. So I err on the side of really super tight stops. If the market doesn't just immediately move in my favor, I just get out. It's worked better for me to do that. All right. So don't revenge trade. Don't think that when you get in, you lose your money. Don't think you're going to get it all back in the next trade either. You got to. The markets can only do three things: they can go up, they can go down, and they can go sideways. But because they can go up, down, and sideways, you've only got a 33% chance of being right, because you can only pick one of those at a time. Right. So unless we're doing an option neutral strategy, which is why we like our wild eye, crazy eye, because it lets us choose two of those. So we have a 66% chance. And actually we don't, because we're just going sideways, but we're going long and short at the same time. So the odds are a little screwed up with those, and that's why it works. All right. Because we get to screw with the odds. But when you're just day trading, you got basically a 33% chance of being right. 66% of the time you're going to be wrong, because the market can go sideways, it can go up, and it can go down. That's all it can do. But you can only choose one of them. All right. So think you're going to lose money more often than you're going to make money, or you're going to get knocked out more times than you're going to catch the right direction. That's why you want to be trying to get good at technical analysis, right? That's why we do these setups and triggers, so we can be good at it. But when you're wrong, just admit it and get out. Don't revenge trade. Don't try and get it all back at once. All right. Personal discipline is the key to your success. Not every day can be a winning day. Learn to accept it and move on. Some days you're going to lose money. That's just the way it is. That's the nature of this beast. So get comfortable with losing money, because that's how it works. You lose, and make. Lose, make. All right. Don't revenge trade. All right, guys, if you like this class and thought that was helpful and you learned anything from it, like, share, and subscribe. Share. If you like this class, copy that little button down at the bottom, share it with some of your friends, post it on your Facebook page. Say, hey, I enjoy this class. Let's get a few more people in here. It's nice having a nice little group, and I love the guys that are here and your stalwarts, but it's always nice to have a bigger group. Let's get more people in here, share it, bring some people in. Like and subscribe. That always helps get more people to come to the class too. And the more people we have in the class, more likely I am to stick around and do this longer. All right, guys. It's great to see you. And we will catch you tomorrow. We've got a very important class. Don't miss it. All right.